Okay, let's unpack this. We've all heard the buzz, right? Blockchain this, DLT that, but today we're taking a deep dive into something a bit different, maybe a bit of a dark horse, really aiming for the big leagues. Hedera Hashgraph. Our mission, basically, is to figure out what makes it tick, why big companies are looking at it, and, what hurdles it's facing. They call it the trust layer of the digital economy. We've got some interesting stuff to draw on, internal reports, forecasts, but also real discussions from the communities actually building on it.
Exactly. And what's really fascinating, I think, is how Hedera isn't just positioning itself as another crypto thing. It's aiming to be foundational infrastructure, for big real-world uses. We need to explore why its specific tech might actually be a game changer for these enterprises, getting past the usual hype.
So let's jump right in. First things first, and this is maybe the key thing. Hedera uses Hashgraph, not blockchain. What does that actually mean? For us trying to get our heads around this digital economy shift.
Yeah, it's a fundamental difference, really. Think about your typical blockchains, Bitcoin, Ethereum, right? They store data in blocks, one after the other. Like a chain, they use proof of work or maybe proof of stake. But these can be, kind of slow, expensive sometimes. And they use a lot of energy, especially at the scale businesses need. Bitcoin, maybe 6 to 8 transactions a second? And you wait 10 minutes for it to be final?
Yeah.
Ethereum's a bit faster, maybe 12, 15 TPS, but finality, still seconds or, minutes if it's congested.
And we've all heard about those crazy Ethereum gas fees when things get busy, that unpredictability. It must be a total nightmare if you're a business trying to budget, right? How does Hedera actually guarantee that low fixed cost, even when the network's slammed? Could that ever change?
That's a really good point, because cost predictability is essential for businesses.
Yeah.
Unlike Ethereum's gas market where prices just shoot up, Hedera's fees are built into the network services. They're designed to stay stable. Now, the value of HBAR itself might change on the market, sure, but the amount of HBAR needed for a specific transaction, that's fixed. Makes costs way more predictable. Hedera's Hashgraph, it uses this thing called a directed acyclic graph, a DAG. So instead of that single chain, imagine more like a web. Transactions get processed and confirmed in parallel, not just one after another. This DAG structure lets it handle a lot more, much faster.
Okay, that sounds like a totally different way of setting things up. And this allows for their gossip and virtual voting, which gets them to asynchronous Byzantine fault tolerance, aBFT. That's a mouthful. What's the bottom line there for security?
It's super important. aBFT is basically the gold standard for security in these distributed systems. It means even if some nodes are offline, or even actively malicious trying to cheat the system, the network still reaches the correct consensus. And fast. Reliably. Think of it like a digital agreement that just can't be faked, even under attack.
Yeah.
That level of guaranteed trust, that finality, it's huge for businesses running critical stuff where data has to be right.
So yeah, it's not just about speed then. The implications are pretty big. It feels less like just an upgrade and more like rethinking how you build trust and speed into these systems from the ground up. So what are the actual numbers? How does Hedera stack up performance-wise?
The numbers are pretty impressive. Hedera is currently throttled at 10,000 transactions per second. And finality, like we said, just 3 to 5 seconds. Energy-wise, it's carbon neutral, maybe even negative. A study from UCL actually showed it uses less energy than a Visa transaction. And the cost, fixed and low, 0.0001 thirds per transaction, 1/100th of a cent. Makes tiny payments, microtransactions totally viable, which is just impossible when you see Ethereum fees hitting hundreds of thousands of dollars in extreme cases.
That cost alone has got to be appealing. But for big companies, it's not just cost, it's stability, right? I heard Hedera talks about a no-fork guarantee. What's that mean, and why is it a big deal compared to other ledgers that can split?
Right, the no-fork thing.
Yeah.
For a big enterprise, that's massive. It's about predictability, mitigating risk. Imagine you build your whole supply chain system on a ledger, and then, poof, it forks, splits into 2 versions. Suddenly, your past data might be iffy, the community splits. It's a nightmare scenario. Hedera's guarantee removes that fundamental threat. That's the kind of bedrock trust big companies need for long-term stuff. And, the tech itself, Hashgraph, it came from Swirl's Lehman Baird, Mans Harman. It was patented. But then the Hedera Governing Council bought the patent and, crucially, open-sourced it in 2022. Apache 2.0 license. That wasn't just legal stuff. It was a big signal about transparency, community building, letting anyone look under the hood. Huge for adoption, especially with cautious enterprises.
Okay, makes sense. Now, every public DLT has its coin. For Hedera, it's HBAR. What's its role here? What does it actually do besides being traded?
HBAR has 2 main jobs, and they're linked. First, yeah, it's network fuel. You pay for everything with HBAR sending crypto, running smart contracts, storing files, using the Hedera consensus service. That pays the nodes running the network for their work. Keeps the lights on, basically. Second, and this is key, HBAR is crucial for network security. It powers their proof-of-stake system. It's coin-weighted.
So holding more HBAR means more influence and consensus. How does that prevent attacks, like someone trying to take over?
Exactly. More HBAR staked means more weight. But to actually disrupt consensus, an attacker would need to get and stake 1/3 of the total HBAR supply. And that total supply is fixed. 50 billion HBAR, all minted back in August 2018. Getting hold of a third of that. It's designed to be incredibly expensive, almost impossible, really. That protects against those Sybil attacks where someone creates fake identities.
50 billion fixed supply. Can that number ever change? And how is it released? I heard it's quite controlled.
It can't be changed unless the governing council unanimously agrees, which is a very high bar. And yeah, the release is very measured. Like back in early 2020, only about 4% was circulating. The projection is less than 31% circulating by the end of this year, 2025. The idea is to let the network mature securely, let the market drive the price, not just speculation or the council flooding the market. Plus, the treasury holdings. There are multi-sig accounts. Needs a majority of the council to approve moving anything. Adds another layer of control.
And can regular HBAR holders participate? Can you stake your coins? What's that like?
Yep, staking's a big part. You can contribute your HBAR's weight to the network security without running a node yourself. It's called proxy staking. And here's a really important difference from a lot of other POS systems. Your staked HBAR isn't locked up. It stays liquid, totally under your control. You can spend it whenever. That's huge flexibility. The rewards for staking, the council sets those. They aim for competitive, but also importantly, compliant with regulations. That ties into their whole enterprise strategy.
Okay, that brings us nicely to the governance, the governing council. This is really unique, isn't it? How does having Google, IBM, Dell, and others running the show build trust? And how does it handle the whole tricky regulation issue in crypto?
It's definitely unique, yeah.
Yeah.
And it's a core part of their pitch. Up to 39 big global names, corporations, universities, Web3 projects. Each gets one vote on the big stuff. Software updates, treasury, pricing, regulation. They have turn limits. They don't get paid by Hedera directly except node fees. The whole structure is designed for decentralized but stable and transparent governance, trying to avoid the drama and splits you see elsewhere. Enterprises like that stability.
It sounds very deliberate, almost like creating a sort of permission public network feel, at least initially. But has that focus, that caution, maybe made it less attractive for the more, move fast and break things Web3 crowd compared to rivals? How does that fit with their regulatory stance?
That's the core tension, isn't it? Hedera's always been, some say, over-compliant. They actively talk to regulators globally, trying to stay ahead of the curve. That's a massive plus for attracting big regulated businesses, no question. But yeah, the flip side is that some argue it slowed down adoption by the more experimental devs, and maybe limited some of the token strategies like those lower staking rewards we mentioned. Especially here in the US, the lack of clear rules has been, frankly, a miserable limbo for everyone. But look elsewhere, like Dubai. With clearer digital asset rules under HBAR, you see Hedera projects like TokenVest, Scintilla doing real-world asset tokenization really taking off. It kind of suggests that once the regulatory fog lifts elsewhere, Hedera could really see growth pick up speed.
Right. So connecting the dots, what does this actually mean for businesses using the tech today? Where are we seeing Hedera really make a difference?
It means we're seeing real traction in some key areas. Decentralized identity, DID, that's a big one. Huge market potential, over 30 million users targeted. Companies like IBM, Wipro building solutions on Hedera for things like smoother logins, better privacy. Though, fair point, some worry centralizing ID data could also be a risk if breached.
Okay, so DID is one. What else?
Payments, definitely. Fast, cheap, clear transactions. Standard Bank Group, for example, partnered with Hedera for cross-border trade, tackling those long settlement delays. Asset tokenization is another hot area, turning things like real estate or luxury goods into digital tokens you can trade. Walltech is apparently tokenizing like $3 billion in assets on Hedera. And the Hedera Token Service, HTS, has built-in compliance tools, KYC, AML checks, freezing accounts, stuff regulated industries need. Then there's data integrity, using the Hedera Consensus Service, HCS, to create tamper-proof logs. Think sustainability tracking or medical records like Safe Health Systems is doing. Supply chain, too. Verifying where products come from, proving authenticity. Suku.world is an example there. And even gaming. Animoca Brands is using it to fight cheating in play-to-earn games, making sure digital items and winnings are legit.
Wow. Okay. That's everything from tracking fancy watches to making sure gamers aren't cheating. It's incredibly broad.
It really shows the versatility, yeah.
But it can't be all smooth sailing. With that much ambition, what are the main challenges Hedera faces trying to get even bigger?
Well, competition for sure. You've got other fast blockchains like Solana boasting maybe 3,000, 4,000 TPS and a really passionate community. Building that same kind of massive grassroots community support that Ethereum or Solana has, that's a challenge for Hedera's more top-down approach. And of course, navigating those regulations as they keep changing. Plus, there are still questions, valid questions, about whether that council model is decentralized enough for true permissionless Web3 purists.
And just touching on the market side briefly, because it does reflect confidence, right? As of today, August 14th, 2025, we're seeing analysts getting pretty bullish on HBAR's price. Grayscale even filed for a Hedera Trust ETF in Delaware recently. That could bring in more institutional money. Some forecasts are pretty wild, suggesting HBAR could hit $3.53 this year. That'd be a huge jump, reflecting, I guess, serious belief in this enterprise strategy. So, wrapping things up, what does this all mean for you listening? We've dug into Hedera's unique tech, its laser focus on enterprise, that careful dance with regulators and governance. It's definitely a unique player in the DLT space, potentially changing how big business works online.
Yeah, and if you zoom out, Hedera really highlights this core tension in the whole DLT world, doesn't it? That constant trade-off, speed, security versus true decentralization. Especially when you try to bring big regulated companies into the fold. It makes you ask, can a network that starts with this strong known council ever really achieve that bottom-up permissionless vibe that many see as the Web3 dream? Or is this trust layer approach, this more pragmatic governed path, actually what's needed for mainstream adoption to finally happen?
That's the big question, isn't it? Think about this. How much decentralization is really enough for the world's biggest players to jump in? And what happens to the digital economy when or if they do?